So I just had a call with Christy Van and we talked about how to get all the money back for every car you ever buy, drive, and own. She loves that because all of her clients, well, they're buying cars. And most of them are buying cars the wrong way, either paying cash, financing, or leasing it. So when you show them how to get all the money back for every car they're gonna buy, drive, and own, they seem to like that. So I went one step further and I said, well, people just don't like making payments. They love new cars, but they hate the payment. So why don't we just find a way to have somebody else make the car payment? So that's the second part of what I talked to her about. How to get somebody else to make your car payment for you. Now I know that sounds too good to be true, but well, it's not. And if you want to learn how that works, watch the video. I'm going to first start with something that all of you need to understand, and that is banking. In order for me to show you how to do what we're going to talk about, you got to understand banking 101. So let's just come over here to the board. First off, most of you understand how banking works. You go into a bank. Let's just assume that the bank pays you an interest rate of 4%. So you are definitely motivated to put money into the bank. So I'm just gonna use 100 grand, okay, folks? You can change the number, you can make it 10 grand, $500, doesn't matter. I just have this on the board. So you deposit $100,000 into a traditional bank. What does that bank do with the money when you put it there? Do they just put it in a little box with your name on it? No. They take your money and they immediately find somebody that needs to borrow that money, and they're going to charge them a higher interest rate than what they're paying you. So if they were paying you 4%, which would be a good interest rate at a bank, they're going to lend it out to somebody at a rate something like 7%, which is probably perfect for today's discussion because if you were to borrow for a home today, the rate is right around 7%. So the bank takes your deposit, in which they're paying you 4%, and they turn it around and they lend it back out. Now here's a unique thing that they just did. Banks are experts at turning liabilities into assets. So when you made that deposit into the bank, that was your money. So that's a liability to the bank. But when the bank turns it around and lends it out, that's an asset to the bank. A loan to a bank is an asset. I'm just trying to help you understand this. Then the bank basically gives the buyer of the home the money. The money transfers to the seller. The seller puts that money back into the bank, creating another issue for the bank because now the bank has to lend that money out again. So they're going to lend it out to what we're going to talk about today, cars. Everybody that's on this has probably used a bank in one way or the other for buying a car, whether it's a lease or financing it. Most of you have done that. And the bank right now, to borrow for a car is about 8%. So same thing, bank lends the money out on the car, then the car dealer gets the money and puts it back into the bank. And round the bank goes. They lend it out to somebody for a home remodeling loan at 9%. Contractors get paid. They've been taught to put the money back in the bank. Bank keeps moving it out, lends it out to somebody that's in big debt with the credit cards. They charge them 12%. Credit cards get their money and put it back in the bank. Round and round we go. All that happened here is the bank took your money and everybody else's money and they lent it out at a higher rate. If we were to add up the spread, so if we looked at each of these, this would be like 3, this would be 4. What I'm doing is the spread. This is how much the bank made in the middle. 3, 4, let's see if I'm doing this right, 5%. Nonetheless, if I did all the math, the bank made 20% in spread. That's how much the bank made, and you made 4%. So you made 4, the bank made 20, which if we divide 4 into 20 to figure out how much more did the bank make than you, that's 5 times more, or 500% more than you made at that bank. So if that doesn't just kind of get you thinking, all I want you to think about is, what business do you want to be in now? You want to be in the banking business, don't you? Because I do. I mean, come on. Banks make 400 to 1,300% more than the depositors. And you can look that up at a place called BauerFinancial.com, and you can look up any bank, and that's how much they make more. So of course you want to be in the banking business. So let's get into the banking business. Now, let's start today's discussion with how do you traditionally buy a car? So let's just go through that because we did that with the bank, but I want to talk about just kind of the flow of how this works. There are a couple different ways you can buy a car, and I'm going to do 2 of them. Number 1, you could pay cash or you could finance the car. Okay, let's just look at these 2 different options. Both of these options are a little bit different because one requires you to save up the money. So let's just say you're going to buy a $30,000 car and you want to pay cash for it. So over here's the the goal. This is the car you want to buy. Don't mind the drawing, okay? I'm just doing this super quick. This is the car you want to buy. It's a $30,000 automobile. Some people save up the money in the bank, and then they take that 30 grand, they go out there and they buy the car. And they love that because they have no car payment. And this is why people pay cash. They saved the money up, they paid cash for the car because they didn't want a car payment. But what did you effectively do by paying cash? You made a huge mistake if you do this. Number one, you lost the earning potential for the rest of your life on $30,000. You saved up 30 grand, but now you bought the car with the $30,000. So that 30 grand can no longer earn any interest or any gains for you for the rest of your life. But you bought a car. What happens to the value of that car? The second you roll it off the lot, it loses value. But over time, the value of this car does this. Every car goes down in value. So it's a depreciating asset. So that 30 grand that you bought the car with, you felt good because now you got a new car, but that car, when it's done and you got to get a new one, it's worth way less. So most people, after a 5-year period, they lose 50+% of the value of their car. That means in 5 years, that car is only going to be worth $15,000, and that's if you can get somebody to pay 15 grand. If you trade that car in at the dealership, they're not going to give you 15. They might only give you 10. So that is just bad business. And that is definitely not the business of banking. So we don't want to buy cars that way, but I want you to think about that. But all I'm going to do is I'm going to eliminate cash from that box, and we're going to add something in a second. The other way you could do it, you could go to a traditional bank and you could finance it, where the bank gives you a loan and they're going to charge you, let's just say 6% on that loan, and then you're going to buy the car. And in this example, you didn't lose the $30,000. $30,000 is still in your bank, earning interest and whatever. But now you've got a loan, and let's say that loan is 6%, and we'll just call it a $500 a month car payment. Okay, that's our numbers. Now what you got to do is you got to pay $500 a month every single month back to the bank to repay that loan. So that's $500 every month that you are losing. $500 a month that you are losing, and that money will never, ever come back to your family again. But you got the car, which we know is going to go down in value. But the good news is now you've got your money in the account earning interest. So the question is, are you earning interest at a higher rate than 6%? Most of you right now would say no. But if you took a little risk with that money, maybe you could, but let's just leave risk off the table. So now, if we wanted to get all the money back for every single car we buy, drive, and own, what we would want to do is we'd want to blend these two options, but we'd want to do them in an account that you are probably not very familiar with. So everything's going to stay the same. So let's not do anything different than what we did before. Because before, remember, you saved up 30 grand and then you bought the car, the first one, which I told you was bad. The second option, you saved up 30 grand, you kept it in a bank account earning interest, but then you took a loan out for the car and you made monthly payments back to the bank, of which you lost all those payments, right? Now, to get all the money back for every car you buy, drive, and own, what we would do is we would first save up the 30 grand, but we would not put the money in someone else's bank. Because do you remember that bank example that I gave you? When you use their bank, they make the spread. They're only going to pay you an interest rate that they want to pay you, and they're always going to charge you more. So you saw how that worked. They made 500% more than you did on the money that you left there. So we just got to change where our savings goes first. And this is going to maybe take some of you by surprise, but where we're going to put that $30,000 or whatever dollar amount you want to save. Now, some of you might be like, no, I don't have 30 grand, but I could save $1,000 a month, or I could save $500 a month. Listen, whatever amount you're saving now, I'm just using numbers because the car is going to cost 30 grand. That's where the 30 comes from. So to get the 30,000, what we might do is we might just save a certain amount per month, 1,000, 500, whatever it is. It doesn't matter what the amount is. That's called your savings. And we're going to change just one thing, folks, about your savings, and that is where that savings goes first. You see, we're not going to put it in their bank. We're going to put it into an account that we're going to call your bank. And that account is none other than a specially designed and engineered whole life insurance policy from a mutually owned insurance company that pays dividends. Now, I know that's a mouthful. Basically, you're going to redirect your savings into a giant mutually owned insurance company, and the product we're going to use is a whole life insurance policy. But we're going to specially design and engineer it so that all the money you put into it is immediately available in the first 30 days, or at least a high percentage. We call it high early cash value. And to do that, the person that builds the whole life policy for you is going to take a reduction in their commission of between 60 and 90%. I did say that correct. So to build the policy to do what you're about to see, the policy has to be designed in a way that maximizes your cash value so that you have access to as much of those deposits that you're putting in as possible because, hey, our goal is to buy a car. So you need to have efficiency in the policy. The only way to do that is to design it so that it reduces the commission that the agent's going to take. Now, agents and advisors will tell you that that's not possible. You can't do that. That's not even legal. You can't reduce commissions. But it is absolutely possible, and we do it every single day. We've done it for over 16,000 clients so far. And how we do it is all in the design and engineer of the policy. Now that you understand that, why would we put money in a whole life policy? Why would this be the place where we'd want the money to start? Well, right now, all the companies that we work with pay anywhere between 5.5 and 6.4%. So just wrap your head around that. They call that the dividend crediting rate. That is how much interest in dividends you will earn on the cash value inside your policy. 5.5 to 6.4%. Those are the range of the companies we work with today. Are you getting more than that at your traditional bank? The answer is absolutely not. I have not found any high yield savings accounts that come even close to this in today's interest rate environment. But not only that, if this is built properly, it's going to grow tax-free. So that interest rate you're going to be earning is going to be earning on a tax-free basis. Not only that, it's protected against judgments and liens in most states. And not only that, it's going to give you a death benefit so that if something should happen and you should pass away and go on to heaven, your family is going to, or whoever your beneficiary is going to get a death benefit paid out to them tax-free. So do you have a savings account that can do all those? Pay you a higher interest rate than what the insurance company is, do it in a tax-free environment, protect it from judgments and liens in most states, and provide a death benefit that's far more than what the value of your account is? I think not. So I think we can all agree that this is simply a better place to store our savings than a traditional bank. Now let's get on to the fun part, getting all the money back for the car. So now you've accomplished the goal. You've saved up the $30,000 needed to go out there and buy the car. So what we're going to do is we're going to do the same thing we would have done before with the bank. We're going to take a loan, but we're going to take a loan from the insurance company. So the insurance company is going to give us $30,000, and that $30,000 is going to come from the cash value that we have saved up inside the whole life policy. Now here's the bad part. The insurance company doesn't do this for free. They're a profit organization. Believe me, if you want these kind of interest rates and dividends on your policy, you want them to be a profit company and you want them to make money. So they are going to charge interest on this loan. So right now, the insurance companies we work with are between 5 and 6% interest. So let's just go right in the middle, 5.5%, which would be more than most of the loan interest rates for the companies we work with, but I just want to kind of give you that range. If you're earning 5.5 to 6.4 and you're paying 5.5, well, I guess let's just kind of go in the middle here since we did the same thing. Let's just say 6% here. If you're earning 6% in a dividend crediting rate and paying 5.5, are you making a spread? Well, hypothetically, the answer would be yes, right? Because you're making more than what you're paying. Right. So now we took the $30,000 loan from the insurance company. Where did the money come from? It didn't come from your account. Your $30,000 is still in your account earning interest and dividends at whatever the dividend crediting rate is. So whose money did the insurance company give you? Well, the insurance company gave you money from their general account. They gave you a loan from their general account, and they collateralized the loan with the cash value you have in your account. But they didn't account for that, meaning your 30 grand still gets to earn uninterrupted compounding interest. No other account that I've ever seen allows you to do this. You are earning money and then still using the money at the same time and making the spread. Normally it's the opposite. The bank makes the spread, but you are becoming your own banker, so you're making the spread. So now let's keep going. You buy the car, but we can't stop there because now we got to change our perception from I'm paying cash for a car, because a lot of you want to think that way, right? Because you saved up the 30 grand and now you took the 30 grand out to buy the car and you're like, that's my money. Fine, that was my money. I saved it up. But you are the bank. So you need to think and act as if you are a bank. And if you were a bank and you borrowed $30,000 from your bank, would you steal from your bank? No. You'd be an honest banker, wouldn't you? Yes. And if you would have financed this car with any other bank, they would have charged you $500 a month. So is it okay if we make $500 a month payments back to our bank? Some of you are confused, like, well, I don't know if that's okay. Well, if that $500 a month that you paid back to your policy every month was money that was now immediately available the next day when your check cleared, would you be okay then? Well, yeah, then it would be no different than me taking the $500 a month that I would have made in a car payment and putting it into the bank account. Precisely. Every payment you make back to your policy is money that you would have given away or money that you would have saved. So we're just going to save it, but we're going to save it in the form of a loan repayment because we borrowed 30 grand from the insurance company, and now we're going to repay that 30 grand in increments of whatever the bank would have charged you, $500 a month. And by doing that, because this is your banking system, you get to keep all 500. Very different than when you finance, because that 500 went to somebody else's bank, but now the 500 is going to your bank. And we already talked about the interest rates. If the insurance company is paying you 6% in a dividend crediting rate, charging you 5.5, you are making a spread. Okay, so, but we could also come over here and say that the bank would have charged us 6, and the insurance company is only going to charge us 5.5. So that's still a spread, but nonetheless, you are in 100% control of every part of your money here. You controlled where you saved it, you controlled what you made, you controlled what you took it out to use it for, and you controlled the payment back, but you lost no leakage of money. It's not like a traditional loan. But here's the most important thing that I want you to factor in here. Every $500 payment that's going back into the policy is repaying this loan, which means the loan balance is going down. So if the loan balance is going down every month and the insurance company is charging 5.5% simple interest on the loan, or is the insurance company not charging you an interest rate on a lower and lower balance every month? So if we figured out what's called the APR, which I'm not going to do this for you today, then every single year you're not really paying 5.5%. You're paying significantly less. And Christy talks about APRs all the time. You see, this is just mathematics, folks. But you see, while one is going down and you're paying less and less to the insurance company, you are earning more and more and more on your cash value because your cash value never lost the earning potential. Remember when I said you took money from your bank, you lost the earning potential on that 30 grand forever. You didn't here. You're continually earning on that $30,000 that you took out and used for the car, but you didn't use your money, you used the insurance company's money. Now here's the other thing. The insurance company will never ask you for that $30,000 back. Never. And this is kind of freaky, and a lot of people make the mistake of, oh, well, if the insurance company doesn't ask for it, I'm not going to make payments back for it. But here's the deal. The insurance company took that loan balance from your death benefit. So if you started with a death benefit of, I don't know, let's just say $500,000, they're going to subtract that 30 grand from your death benefit. So now your family would get $30,000 less if you passed away. So when you're repaying the loan, the $500 a month that you're repaying it with is money that becomes available to you the next day, but it also is replenishing your death benefit. You see, this is how it works. So if you did just this, if you started the savings with the whole life, took the money out, bought the car, made payments back to the policy for the car, here's what would happen, and I've got other videos I've done with Christy that show this. You will get all the money back for every single car you buy, drive, and own. That isn't a speculation. That is a fact. It's just mathematical certainty. You can't not get all the money back because instead of making the payments to someone else, you're making the payments to yourself. And the payments you're making to yourself include interest and principal. And the only thing you lose is what interest you pay to the insurance company, but that's okay because the insurance company is paying you more in interest and dividends than what they're charging you. So therefore, you have flipped the script. You have become the bank. But you see here, it gets even better. Remember I said I was going to teach two things in the beginning when Christy and I were kind of riffing. I said, I'm going to teach you not just how to get all the money back for all the cars you buy, drive, and own. I'm going to teach you also how to have somebody else make your car payments for you. So this is a little different. As long as you understand this, all it is a circle, okay? We'll go one step further. Now, this might not be applicable for every one of you, but we're going to flip over to a thing called Private Money Club. We always refer to it as PMC. Okay, so actually, I'm going to put PMC over here, privatemoneyclub.com. All this is think of it as like a dating site for money. It's a place where all of you can go. You can create a profile. There's no cost for creating a profile or using it. Okay, it's 100% free. And you basically can go on there, create a profile, and you can say, I am one of two things. I am a borrower or I am a lender. Because there are only two types of people in this site, people with money and people that need money. And both have a problem that each other can solve. People that have money, like myself, like Christy, and like a lot of you, the one thing we're always talking about is how do we make more money? How do we make our money earn us more money so that we don't have to work harder, longer, or take on any additional risk? Our money's just working for us, okay? And then in order to do that, what we do is we lend money to borrowers that have real estate deals that we like, things we know, like, and understand. So that's all PMC is. It's like a borrowing and lending site for private lenders. So now that you understand the dating site for money called privatemoneyclub.com, let's talk about how somebody else can make your car payments for you. So over here, I'm going to assume that now that you've learned about this specially designed and whole life policy and this concept called IBC. Now remember, here's the concept, okay? It went like this. Money starts in the policy, goes to work, then that place where it works comes back to the policy. Before we did it, that was your car payments coming back to the policy. But now we don't want to pay for our own car. We want someone else to pay for it. So I'm just going to kind of quickly do the math, and I'm just going to grab a calculator because I'm just doing this on the cuff. I just need to do some quick calculations. Let's just say our goal is we want to buy a car, okay? And over here, I'm just going to draw the car down here a little bit smaller. Okay, we're going to buy a $30,000 car, and that payment on the car is going to be $500 a month. Now, we could have taken the loan from the whole life and bought the car. We already went over that. You'd get all the money back for every car you buy, drive, and own. But what else could we do? Well, let's just say somebody saved up or had $50,000 in their whole life. Okay, and I just got to do the math. Let's see if I can reverse engineer this the right way. Now, what you would do is you'd come over here to Private Money Club and you would identify some deal on Private Money Club that makes sense. So actually, I think this will be fun. Let's do this. Let me log in real quick, Christy. And then what we're going to do is we're actually going to show people that are watching this Private Money Club. And we're going to do a live look and see if what I'm saying is actually true. So here's Private Money Club. If you can see that. What we're in mine. Now there's the community tab, but let's just go right into the deals. Okay, here's a $500,000 deal, a 75. What we're looking for is we're looking for a deal around 50 grand. Or a deal that we can lend 15 grand. Oh, here's one. Okay, let's just say we said to this person right here, and I didn't plan this, folks. I was literally just looking for a $50,000 deal to match what we're talking about. So right here, this person's got a rehab on half an acre, and they're looking for some lender to lend them $55,000 in a first lien position, which is what I would prefer, because I want to be first, not last. I want to be first lien on the mortgage, and they're willing to pay 15%. So we could pull this deal up. We could look at the photos of the deal. Looks like it's, I don't know, looks like maybe a mobile home with some type of a thing here in the front, but that's not important. Yep, mobile home with a workshop on half an acre, 55 grand plus 30 grand in rehab. So it looks like they're raising 55 at 15% interest for a period of 6 months, okay? So there's our deal. And I could hit this person up and say, hey, I'm interested. But now we've identified a deal on Private Money Club. You would do more due diligence than this, but we've got our numbers. So I'd say I'm interested, okay? Now let's stop sharing. Now let's come back over to the board. Now let's look at how this works. Let's actually just use the real numbers, 55 grand. If you had 55 grand in cash value that you saved up in your whole life, you know you can buy the car by taking a loan, but let's do something even more fun. We just found this really cool deal that's paying 15% in a first lien position. So what if we take 55 grand and we borrow that money from the policy? Now remember the math, 5.5% is the number I'm going to use. Your policy's earning 6%. Okay, these are just hypothetical numbers, but I'm just putting them up there. They're pretty close to what you'd earn, either more or less on the loan amount. So you take this loan from the policy and you lend it on this piece of real estate. So right off the bat, that makes sense. If you're making 15% and it costs you 5.5%, how many of you would do that deal? I would do it all day long. Okay. Or if I just looked at it from the simple sake of if I'm earning 6 and I'm paying 5.5, I'm making a spread there too. So we got to kind of pick and choose which side we want the spread to go on, but I'm just going to do it over here. Okay. We're going to do it right here by saying 15% minus 5.5. That's how we're going to do it. So 15 minus 5.5 means we are making a spread by doing this deal of 9.5%. Okay, that's our spread. Not too bad. Okay, most people would jump at this opportunity, but we're doing this so that somebody else makes our car payment. And our car payment, we already know, is $500 a month. So over here, we got 55 grand that we lent on this deal in first lien position at 15%. So times 0.15, that means we're going to make over the course of a year. Now I know it was only a 6-month deal, but let's just assume that it goes for a year. That's $82.50 divided by 12. That's $687.50 every single month that we're going to earn. Now we only need $500 to pay for the car. So we're literally going to come out ahead after we pay for our car of $187 per month. So we take the $687.50 in interest that we earned on this private lending deal. We use $500 of it to pay for our car. Who's paying for the car? Are you paying for the car? Or is that borrower paying for the car? Well, the borrower is really, because the borrower is paying you 15% interest on that loan. So you're taking the interest, just a portion of it, and you're using that to pay the car. You're taking the other $187.50 a month that you'd be earning, and we're going to put that back into the policy. So now $187.50 is going to go back into the policy every single month. Okay, it's going to service some of this loan interest rate on that $55,000 loan, but this money is going to be available for you every single time. The $500 a month that goes to the car, that's going to someone else's bank because you financed that car for somebody else's bank. Okay, in this hypothetical example, when the car is done and you're done with it, you sell it and you repay the policy. But see, here's another thing that happens. When this deal comes due, you got 55 grand that comes back. So now we put the 55,000 back into the policy. It's made whole, but yes, now you got to repeat the process and you got to find another deal over and over. So I might have went too far with that, folks, but what I'm trying to explain is it's not hard to get someone else to pay for your car if you understand banking and you understand how to be the bank on Private Money Club. And I showed you a real deal on there right now that could do that for you.
That is absolutely amazing. I was sitting here, if you see, I'm taking notes. The point being that, wow, I mean, if I can get people in a position to where their cash flow is up even, monthly with what their expenses are now, they can turn right around and do exactly what you've showed us here today. I mean, it's even overwhelming to me how simple it is. And that's why I take notes, is because I want to be sure that I'm explaining it in a way that people understand that, I get so tired of hearing people say, well, it's a scam, or, you all are just selling us something. I'm not a salesman. And I don't like salesmen. So the point being is that anything that I bring to my audience is going to serve them if they will just study into it themselves and figure this out for what it looks like in their situation. But if we can get people to a place they even have some cash flow, much less, like I've said before, using your lines of credit to fund these things and then allow, the whole life insurance interest and the PMC to work together to pay for your things. We're talking about never being in debt again. This
Right.
is just being smart with our money to the greatest extent, so that you, and not only you but your families, are going to absolutely never have to go to a bank again. That's amazing. That's amazing. So what you have said, it's an eye opener for me every single time we talk. This is an amazing system that you have set up here with this private money club. I think that the thing that amazed me today about what you said was, this is a simple interest loan. This isn't the amortization schedule that we're dealing with at the banks. Regardless, you're going to win because you're basically just refunding, at a simple interest what you have borrowed from yourself. It
Correct.
doesn't get better than that.
I think there's a really important thing that I didn't call out there, but I know you teach this all the time. So for your audience, this will resonate. Is you're oftentimes talking the difference between amortized loans and simple loans, and I know in some of yours, I've watched some of your videos where you even show a HELOC at a higher interest rate than a fixed rate mortgage, where at the end of the day they pay significantly less on the higher interest rate than they do the lower amortized interest, and it's because of the way the interest is calculated. But here's one of the other things that's important to realize: when you borrow from an insurance company, the insurance company doesn't base their loan interest rate the same way a bank does. Banks use prime rate, right? They'll do off whatever the overnight rate is, or the prime rate is usually how they're going to peg it. So as soon as the Fed makes a move or makes a thing, that rate's always changing. Insurance companies tie their loan interest rate more to the bond LIBOR interest rate, which is a much more level interest. So these rates rarely change. I mean, I've seen them in the last 20 years fluctuate from 4 to 6%. You've seen interest rates at banks go up 10% and fluctuate all over the place. So this is just a lot more stable way to look at it. But yes, the interest that the insurance companies charge is always charged simple interest, because that's just how they run their books and how they do it.
That is crazy, because if you look at the average today of a HELOC, you're talking about 9.25%. And
Yep.
then if you're moving into a personal line of credit, you're maybe 14, 16%. So this just makes sense all the way around. That's what I said. My eyes have really been open to how the American people are really, really going to benefit in much better ways than just doing velocity banking on its own. So I appreciate you so much when you come on here and you take the time to talk to me and my audience. It's beautiful because your system works. There's no ands, ifs, or buts. You're talking about something, and I believe you've said before that the banks have paid a dividend for over 140 years. I
The
believe you
insurance
said.
companies. Yeah, I don't
I'm
think many
sorry.
banks pay dividends, but the
I'm
insurance
sorry,
companies.
yeah, the insurance company pays over 140% in these dividends that they're paying. Gosh, okay, calm down. I'm going to redo this. The insurance companies have paid a dividend for the last 140 years, I believe you said.
Yeah,
So,
more than that, most of them. Mhm.
see, that is crazy. So, again, thank you so much for coming on and sharing this with me and with the audience. I am going to do more videos with you because people need this. This isn't, like I said, it's not a sales call. This is something that we all need. And since I've been working with you more recently, like we have been doing with these videos, I have been funding my policies with joy. Because why wouldn't I? It makes so much sense. So thank you. Thank you so much for taking the time. And guys, if you're watching this, know that this is something that you can implement. And I get the question all the time, well, what if I can't be approved for the insurance policy due to, previous health problems? Like he's told us in the past videos, you can get these on your children, your grandchildren. Everybody can benefit from this. So definitely take some time to watch these videos, learn the process, talk to Chris Naugle's team, he has a wonderful implementation team that is going to be able to help you get set up in any way you need and that you're wanting to do for your family. And we will see you in the next video.